Hello and welcome. Today we'll look at Wyckoff method. We'll analyze the events in the accumulation and distribution phases, and we'll cover the main guidelines for finding the best trades with excellent risk-to-reward ratios. So, if you could, like, subscribe to the channel, and stick around for the full video. Ranges that are formed at the end of a previous trend bring a balance and supply and demand of a market. In such ranges, neither buying nor selling activity will be large enough to create significant movement towards upside or downside. Accumulation is nothing but a sideways market activity that happens after an extended downtrend. This is the phase where the smart money try to acquire positions without moving the prices too much to the upside. Distribution is a range-bound market activity that happens after an extended uptrend. This is the phase where smart money try to sell off their positions without moving the prices too much to the downside. You may want to watch this video first if you want to know the basics of Wyckoff trading. Richard Wyckoff offered detailed guidelines for spotting accumulation and distribution phases based on certain patterns that take place within them. I will try to keep it very simple and explain each phase. First, let's analyze Wyckoff events during accumulation. First, we have the preliminary support. This is where substantial buying begins to provide pronounced support after a prolonged down move. Volume increases and price spread widens, signaling that the down move may be approaching its end. Next is the selling climax, which is the point at which widening spread and selling pressure usually climaxes, and heavy or panic selling by the public is being absorbed by smart money at or near a bottom. Often, price will close well off the low in a selling climax, reflecting the buying from the smart money. Then we have the automatic rally, which occurs because intense selling pressure has greatly diminished. A wave of buying easily pushes the prices up. The high of this rally will help define the upper boundary of an accumulation trading range. Next is the secondary test, in which price revisits the area of the selling climax to test the supply and demand balance at these levels. If a bottom is to be confirmed, volume and price spread should be significantly diminished as the market approaches support in the area of the selling climax. Also, it's common to have multiple secondary tests after a selling climax. Next is the sign of strength, which is a price advance on increasing spread and relatively higher volume. Often, a sign of strength takes place after a spring. A Wyckoff spring occurs when price falls below its trading range and makes a new panic low, and then springs back into its previous range. The last point of support is the low point of a reaction or a pullback after a sign of strength. The last point of support is the final drive toward the bottom of the accumulation area before the uptrend begins. A last point of support makes a higher low and then turns upward. And finally, we have the backup. A backup is a common structural element preceding a more substantial price markup and can take on a variety of forms, including a simple pullback or a new trading range at a higher level. Now let's analyze Wyckoff phases during accumulation. Phase A. Up to this point, supply has been dominant. The decrease of supply is evidenced in the preliminary support and the selling climax. These events are often very obvious on the chart, with widening spread and heavy volume. Once these intense selling pressures have been relieved, an automatic rally typically occurs. A successful secondary test in the area of the selling climax will show less selling than previously and a narrowing of spread and decreased volume, generally stopping at or above the same price level as the selling climax. If the secondary test goes lower than the selling climax, you can anticipate either new lows or a prolonged consolidation. The lows of the selling climax and the secondary test and the high of the automatic rally set the boundaries of the trading range. Sometimes the trend may end less dramatically without climatic price and volume action. In general, however, it's preferable to see the preliminary support, the selling climax, the automatic rally, and the secondary test as these provide not only a more distinct landscape, but a clear indication that smart money have definitely initiated accumulation. In phase B, smart money are accumulating at relatively low price in anticipation of a next markup. There are usually multiple secondary tests during phase B, as well as upthrust actions at the upper end of the trading range. In phase B, the price swings tend to be wide, with high volume. As professionals absorb the supply, however, the volume on the downswings within the trading range tends to diminish. In phase C, price goes through a decisive test of the remaining supply, allowing the smart money to ascertain whether the price is ready to be marked up. As I said earlier, a spring is a price move below the support level of the trading range, established in phases A and B, that quickly reverses and moves back into the trading range. It's an example of a bear trap, because the drop below support appears to signal the resumption of the downtrend. In reality, this marks the beginning of a new uptrend, trapping the late sellers. In Wyckoff's method, a successful test of the supply, represented by a spring or a shakeout, provides a high probability trading opportunity. The appearance of a sign of strength shortly after a spring or a shakeout validates the analysis. Please note that the testing of supply can occur higher up in a trading range without a spring or a shakeout. In phase D, if we are correct in our analysis, what should follow is the consistent dominance of demand over supply. This is evidenced by a pattern of advances, sign of strength, on widening price spreads and increasing volume, as well as a last point of support on smaller spread and diminished volumes. During phase D, the price will move at least to the top of the trading range. The last point of support in this phase are generally excellent places to initiate or add to long positions. In phase E, the price leaves the trading range, demand is in full control, and the markup is obvious to everyone. New trading ranges can occur. This concept is also known as reaccumulation by smart money. These trading ranges are sometimes called stepping stones on the way to even higher price targets. Now let's showcase Wyckoff events for distribution. First is the preliminary support, where smart money begin to unload shares after a pronounced upmove. Volume expands and price spread widens, signaling that a change in trend may be approaching. Then we have the buying climax, during which you'll see increases in volume and price spread. The force of buying reaches a climax, with heavy or urgent buying by the public being filled by the smart money at prices near a top. A buying climax often coincides with a great earnings report or other good news, since smart money require huge demand from the public to sell their shares without lowering the price. Then we have the automatic rally, with intense buying substantially diminished after the buying climax and heavy supply continuing. An automatic reaction takes place. The low of this sell-off helps define the lower boundary of the distribution trading range. Then we have the secondary test, in which price revisits the area of the buying climax to test the demand-supply balance at these price levels. For a top to be confirmed, supply must outweigh demand. Volume and spread should thus decrease as price approaches the resistance area of the buying climax. A secondary test may take the form of an upthrust, in which price moves above the resistance represented by the buying climax, and possibly other secondary tests, before quickly reversing to close below resistance. After an upthrust, price often tests the lower boundary of the trading range. Then we have the sign of weakness, observable as a down move to or slightly past the lower boundary of the trading range, usually occurring on increased spread and volume. The automatic reaction and the initial sign of weakness indicate a change of character in the price action. Supply is now dominant. Next is the last point of supply. After testing the support on a sign of weakness, a rally on narrow spread shows that the market is having considerable difficulty advancing. This inability to rally may be due to weak demand, substantial supply, or both. The last point of supply represents the exhaustion of demand and the last waves of smart money distribution before the markdown begins. And finally, we have the upthrust after distribution, which occurs in the later stages of the trading range and provides a definitive test of the new demand after a breakout above trading range resistance. An upthrust after distribution is not a required structural element. And here are Wyckoff phases during distribution. Phase A in a distribution trading range marks the stopping of the prior uptrend. Up to this point, demand has been dominant, and the first significant evidence of supply entering the market is provided by the preliminary support and the buying climax. These events are usually followed by an automatic reaction and a secondary test of the buying climax, often with diminished volume. However, the uptrend may also terminate without climatic action, instead demonstrating exhaustion of demand with decreasing spread and volume. During Phase B, smart money review their portfolios and initiate short positions in anticipation of the next markdown. This process shows that the supply and demand balance has tilted downward, supply instead of demand. For instance, signs of weakness are usually followed by significantly increased spread and volume to the downside. Phase C is the most interesting phase of the distribution. This is the time when many retail traders go long during one of the most popular traps. In other words, Phase C is the phase of misleading retail traders. Aggressive traders open short positions after the upthrust, as they have a very good risk-to-reward ratio. But big players are not ready to allow retail traders to make money so easily. This is the reason why very often you can see a few upthrusts, one after the other, basically stop hunting in action. Conservative traders wait to open shorts until Phase D, at the last point of supply. Phase D shows us the last signs of demand. Price goes to or through the trading range support. The evidence that supply is clearly dominant increases, either with a clear breakout of support or with a decline below the midpoint of the trading range after an upthrust or an upthrust after distribution. The best strategy in Phase D is to go short at the last point of supply. In Phase E of Wyckoff distribution, price leaves the trading range and supply is in control. Once the trading range support is broken on a major sign of weakness, this breakdown is often tested with a rally that fails at or near support. This also represents a high probability opportunity to initiate short positions. After a significant down move, climatic action may signal the beginning of a redistribution trading range or of a new phase of accumulation. If you learned something new and want more Wyckoff videos, please hit a like button since it really helps us out, and subscribe to stay up to date with our latest releases. And check out our Academy program if you want to further level up your trading. Until next time.